Welcome to the Deep Dive. We're here to break down dense corporate reports into, well, insight you can actually use. Today, we are digging into Aehr Test Systems, specifically their fiscal 2026 first quarter results call. Happened October 6th, right after the market closed. And wow, the reaction was immediate. The stock had been on a tear, a huge run up, and then bam, double-digit drop right after the call.
Yeah, that whiplash, that immediate sell-off, it tells you a lot about how the market felt instantly. So our job today, synthesize those headline numbers, unpack the story management told heavily, leaning into AI and high-performance computing, and really figure out what's winning right now. Is it the promise of long-term AI growth or the kind of ugly near-term financials?
Okay, let's start with that snapshot. Revenue came in at $11.0 million. Now, that's down 16% year over year, but it did land right around the midpoint of what analysts expected.
Right. And the non-GAAP EPS, that actually beat estimates slightly, came in at a penny per share against expectations of maybe 0 or negative 1 cent.
But like you said, the market just blew right past that beat, focused entirely on the GAAP loss, a loss of negative 7 cents per share. So for you listening, why did that big GAAP loss seemingly overshadow the non-GAAP beat this time?
Well, it really exposes the true cost of the strategic shift they're making. See, non-GAAP, it's useful, it shows core operations, kind of smooths things out. But GAAP, that's generally accepted accounting principles, it gives you the, let's say, unvarnished truth. And that negative 7 cent tells us they are aggressively spending cash right now. Big-time R&D investments for these future AI plays, they're essentially front-loading the cost, and the market, well, it doesn't love seeing that real cash burn.
Okay, so that underlying profitability dip, shown starkly by GAAP, was the big red flag. Order flow looked okay, maybe a bit mixed. Bookings were $11.4 million. Total backlog now sits at $17.5 million. Management tried to frame it positively. We beat the street. But investors clearly zeroed in on the profit hit.
Absolutely. And you see that pain point. I mean, really see it. When you look at the gross margins.
Yeah, let's get into that. It was rough. Non-GAAP gross margin just fell off a cliff. 54.7% last year, down to 37.5% this quarter. That's almost a 17-point drop on revenue that only fell 16%. How does that happen? What's the main culprit?
One word, really. Mix. Product mix. Last year's Q1 was, frankly, an outlier. They sold a ton of high-margin consumables, those wafer packs they make, made up something like 92% of revenue then, just huge this quarter. That slice fell to just $2.6 million, only 24% of revenue.
Wait, 92% down to 24%. That's not just shifting the mix. That's like changing the whole recipe.
Exactly. They basically swapped out those high-margin consumables for lower-margin hardware systems because they're pushing into these AI trials, right?
Right.
And when you ship big systems, often with third-party stuff like probers integrated, which have lower margins baked in, your overall margin just takes a hit. So that margin drop, you could almost see it as the sort of temporary price tag for buying their way into this high-power AI game.
Which connects straight to the spending side too, right? The operating expenses. Non-GAAP OPEX went up 8% to $5.9 million. Management framed it carefully, though said it was R&D supporting AI.
Right. Paying the entry fee, like you said. And structurally, it seems they're actually ready for the scale-up. They finished that big facility renovation, $6.3 million, boosted manufacturing capacity by, they said, at least 5 times, specifically for high-power AI systems. And, importantly, they signaled no more big facility capex needed for expansion. So they think they're set to scale without, draining more cash on buildings.
Okay, structure's ready. Let's pivot to the strategic story then. This is where management sounded, pretty confident. The message is clear. Shift away from just EV and silicon carbide. Focus on AI and high-performance computing reliability. That's the multi-year growth engine now.
And they did offer some pretty solid proof points there for packaged parts using their Sonoma systems. They highlighted a world-leading hyperscaler, didn't name names, of course, placing multiple follow-on volume production orders. Apparently that customer even asked for shorter lead times and ordered 6 more systems back in August. Needs more capacity for their advanced AI chips. So that suggests, packaged part burn-in. It's becoming pretty essential for these custom AI chips at volume.
That's definitely compelling for the Sonoma side. But the really big long-term play, the differentiator, seems to be moving testing earlier to the wafer level with their Vox XP systems.
Yeah, and the traction there seems to be accelerating. They pointed out the world's first production wafer-level burn-in WLBI systems for AI chips are now installed at a major OSAT.
Okay, OSAT, that's outsourced semiconductor assembly and test. For folks maybe less familiar, why is getting into those big OSATs so critical for volume?
because that's where the heavy lifting happens for manufacturing advanced chips, you know. If an OSAT adopts your tech, it basically validates it for potentially dozens of chip designers who use them. And this leads to, I think, the absolute core insight, the thing that could change the whole investment case.
Yeah.
The power density advantage.
Right. Management really hammered this point home. The thermal capability, the power capability of the Fox XP.
It's potentially a game changer. It's their competitive moat. These systems, they can deliver 3.5 kilowatts of power per wafer across 9 wafers in one machine. Compare that to standard probers, maybe 300 watts. Max is a huge difference. And this high power, this thermal management, it isn't just about being efficient. It might actually be about feasibility. We hear hyperscalers are genuinely running into problems, getting permits for enough power for these massive rack-level burn-in farms they need. So if Aehr Test can do that same critical reliability step, but at the wafer level, using less overall facility power, it potentially removes a massive infrastructure bottleneck. Suddenly, their tech isn't just a cost saver, it's maybe a must-have enabler for scaling AI massively.
That is a potentially huge structural advantage.
Yeah.
And they also hit it at another emerging market tied to this power need, high bandwidth flash, HBF.
Right, HBF. It's all about getting massive amounts of memory close to the AI processors. And guess what? Testing it requires way more power than traditional memory. So again, Aehr Test looks positioned because, well, the existing test gear might just not handle the power demands. Creates a whole new opportunity for them.
Okay, so all this positive momentum operationally in AI, the orders, the evaluation starting, the factory ready to go, yet, and this is the big but, the company did not reinstate formal financial guidance for the rest of the fiscal year. And that uncertainty, plus the JAP loss we talk about, seems to be the real sticking point for the market right now.
It really was. They blamed ongoing tariff uncertainty, needing more clarity there. And while management voiced confidence, broadly speaking, AI, Cephalon, photonics, hard drives, GaN without a specific number, it just creates this vacuum. Investors hate that kind of uncertainty. It definitely contributed probably heavily to that sell-off.
And what about silicon carbide? Silicarmi was the big story last year, right? That really drove the stock up. What's the latest thinking there?
They're still expecting SiC growth, but it's weighted more towards the second half of this fiscal year and strengthening into fiscal 27. Management made a really strong case on reliability, though, pointed to their high-voltage 18-wafer system. Their argument is basically skipping burn-in for these SiC devices. They will fail in the car eventually. It's a safety issue. And the cost for wafer-level burn-in is pretty low, around 12 cents per die for a 24-hour cycle, they said. So the reliability argument is strong, even if the timing for that market's recovery got pushed out a bit.
So it creates this dramatic disconnect. Management's painting a picture of a long-term AI platform shift with this key power feasibility edge. But the market is laser focused on the immediate numbers, the gap loss, the margin compression, and crucially, the lack of guidance. And that gap just hammered the stock.
Yep. Which, sets up kind of an interesting scenario if you're watching this company.
Indeed. Which brings us to our segment. This is not financial advice. Let's be crystal clear on that. But given that huge run-up, then the sharp correction, and knowing the big potential catalyst that WLBI production starting, the SiNXP market hopefully recovering, are likely weighted towards the second half of calendar 2026. Well, the thesis could be that the stock might just tread water, maybe drift a bit for several quarters.
Right. So you need a trade that sort of plays that waiting game and positions you for a potentially sharp move up when or if the good news finally hits and gets recognized.
Okay, so here's the outrageous but plausible idea. Use the current, probably elevated near-term volatility, maybe sell a relatively tight put spread, say 30 or 45 days out, collect that premium up front, then use that cash generated to buy long-dated out-of-the-money call options, like January 2027 expiration or even later.
So the thinking is, you collect income now, betting the stock doesn't totally collapse in the very near term. And you use that income to buy lottery tickets, essentially, on the big AI platform story finally playing out. If management eventually does reinstate guidance or they announce that big WLBI customer is ramping to full production, the stock could, re-rate violently upwards. And those long-dated cheap calls could potentially offer some serious leverage. It's definitely a patience play. Betting the long-term AI pivot eventually wins out over the near-term financial headwinds.
All right, let's wrap this up. The core tension is pretty clear, isn't it? You got real operational momentum, this critical power advantage in the booming AI space, clashing directly with these financial speed bumps, the gap loss, the margin hit, and that lack of clear near-term guidance.
Yeah. Ultimately, the market's trying to figure out how to value a company that's fundamentally shifting its business. Is it this high-growth AI enabler whose results are just temporarily messy because of the transition? Or is it a company whose previous growth driver, CES, maybe peaked, and they're trying to talk up the next big thing? That's the debate.
Okay, so here's that final thought for you to chew on. If Aehr Test Systems genuinely holds a unique key, that high-power wafer-level burn-in capability that might be necessary for scaling AI efficiently given power constraints, does the sheer speed and scale of AI build-out, coupled with how hard it is to get power permits, eventually force hyperscalers and OSATs to adopt their tech en masse? Does it transform from just another piece of equipment into a mandatory competitive advantage for anyone serious about AI chips?
That's the multi-billion-dollar question, isn't it? That's the inflection point we'll all be watching for.
We'll certainly keep tracking how this shift towards an AI reliability platform unfolds. Thanks for diving up with us today.